what's going on YouTube? Gent here, real estate sales representative with Remax Center in Cambridge. We're here for video 2, and of course I'm sporting the stylish isolation vibe for 2020. And this is video 2 of our 4-part video series for first-time home buyers. This video is going to be all about the numbers, so don't get discouraged with this video. There's a lot of stuff that's going to get thrown at you. I'll do my best to explain it as easy as I can. I'm going to give you some examples, so hopefully you leave today with a little bit more knowledge than you came in. All right, to start off, I want to do 2 disclaimers, okay? Number 1, this is my knowledge and understanding and opinion as of today's date, which is the middle of April in 2020. So if stuff changes after you watch this or you don't like my opinion, just be warned to start off. And number 2, with any real estate, I would highly recommend you surround yourself with a good team. Okay, number 1, I would suggest a real estate agent. Number 2, I would suggest somebody who's going to lend you money, whether that be through a bank or through a mortgage broker. I'll explain the difference in a little bit. And number 3, you want yourself a good real estate lawyer. Okay, the lawyer is the final check and balance for all of this. I would suggest you start with a real estate agent because they typically can have the other 2 and you can go from there. But really interview who you want, talk to people who you want, and then get yourself a really good team around you that's going to help you and guide you, not only with your first home, but later on down the road. All right, let's go over some key terms that we're going to be using in this video that's all around numbers, which is basically about your mortgage. So the first couple of key terms are as follows. Down payment. Down payment means the amount of money you're going to put down or you're going to pay towards the house before you even own it. So you put money down and that's going to come off of the total amount of the home. So let's say you buy a home that's $400,000, you put $20,000 down, you still owe $380,000. Our next term is called amortization. Amortization is the amount of years it's going to take you to pay back your loan or pay back your mortgage. So typically that comes in 20, 25, or 30 years. Rate. Rate is the amount of interest that's going to be charged on you for a certain period of time. So for example, if you borrow $400,000 from the bank, you're not just paying back $400,000, you're paying back that with interest, and that's the rate. Term. Term is the length of period the bank or lender guarantees your rate. Okay, so a term, so let's say you do an amortization for 25 years. Your term would be for 5 years, for example, which is pretty typical. So your rate of 3% is guaranteed for 5 years. If you choose to sell within that 5 years, there could be some penalties for breaking your term. When it comes to rate also, there's 2 different types of rate. There's variable and fixed, and they mean exactly how they sound. Fixed is if you get a rate of 3%, that is guaranteed and set for that 5 years. It can't go up, it can't go down. That's what you get for 5 years. Variable is if you get 3%, it could go up and it could go down based on the Bank of Canada's rates and how they go up, okay? I highly recommend that you talk to somebody and see what works best for you. I believe personally in the variable rate. I think over time it works out to saving you more money, but that's what works for me. Also, when it comes to your term, when it comes to selling or breaking your mortgage within that first 5 years, if you're in a fixed rate, it's going to actually cost you probably more than if you're in a variable rate. But again, that's something you need to look into and something you need to be aware of before you lock yourself in. If you lock yourself in for 5 years, but you're planning on moving in 3, well, you need to know how much that breaking that mortgage is with still 2 years left in your term. And along that same lines, there's another thing that's called the stress test. So when you go to qualify for your mortgage, when you go to get your loan and your term and everything, they're going to do a stress test on you, and that's a 5-year projection of the rates. Let's just say, for example, the stress test is 5.3%. So you actually have to qualify for 5.3%, even though you're getting a rate of 3%, you still qualify at 5.3. Now that came in after 2008 when the recession happened because everybody was maxed out. They were at the 3% and they couldn't afford a dime more. And then interest rates went up and people were losing their houses. So they implemented this stress test. Now let's talk about getting money. You can get money in a couple different ways, but there's 2 main ones. From a bank or from a mortgage broker, okay? There's nothing wrong with either, and everybody's going to have their own opinion on which one they think you should go with. Again, I highly recommend that you do some research. There's nothing wrong with you going to talk to a bank, going to talk to a couple banks, going to talk to a couple mortgage brokers, and seeing what they do for you. I highly recommend you interviewing a bunch of people. right? There's, when it comes to real estate agents, lawyers, banks, or lenders, there's nothing wrong with you going to check out a few others and seeing what they can do for you, and honestly seeing personality fit as well. When it comes to a bank, though, typically they are just dealing with their product. So if you're with a mainstream bank, you're just borrowing their money. When you deal with a mortgage broker, they tend to have a number of different lenders. Banks are certainly solid. Banks aren't going anywhere. The only thing I would say is that a bank tends to be kind of your straightforward, square, I fit easily into this category and I deal with this person, and it's great dealing with them. I've had wonderful experiences dealing with banks, but I also know that some people haven't because they don't have that personal relationship. When you have a mortgage broker, it's a personal relationship. It's somebody that you can text. It's somebody that you can call. They're going to work hard for you to get a loan. Also, if you tend to kind of be a troubled case, let's say, or you have a little bit of trouble or a little bit more difficulties getting a mortgage broker might be able to do a little more tricks for you and help you out. All right, so let's talk about down payment. Down payment, you're going to have to do regardless of what you buy. When you're looking at a down payment, the magic number is 20%. Under 20% is an uninsured mortgage, and over 20% is an insured mortgage. There's a few differences. An insured mortgage, you can get an amortization for 30 years. As opposed to an uninsured mortgage, you can only go up to 25 years. Now, why does that make such a big difference, right? You're thinking, if I'm borrowing now and I'm 25, I'm going to want to have my mortgage paid off before I retire. So does it really matter that extra 5 years? In that long-term outlook, no, it doesn't. But what it makes a difference for is your monthly payments. So let's compare the two monthly payments. So this is just simple numbers. So if you borrow $400,000 at 3.2% for 25 years, your monthly payment is going to be $1,932 and some change. But $1,932, just call it $1,940. Now let's compare that to, we've added 5 more years to our amortization. So now it's a 30 years. So same thing, $400,000 loan, 3.2%, but now for 30 years, your monthly payment is $1,729. So that is a good chunk of change that is going to monthly be in your pocket or be paid to the lender. Also, when it comes to your down payment and being insured or uninsured, the other thing too is that you actually might get a better rate with an insured mortgage, because if you default or you're unable to pay it, your money is insured by CMHC, which is making sure that the bank gets their money back. So you actually kind of get a little bit of a better rate than if you're an uninsured mortgage. However, because it's an insured mortgage, just like any insurance policy, you have a premium. So that premium, the bank doesn't pay for it or the lender doesn't pay for it, it goes on your payment. So, it's going to be a significant amount of difference for an uninsured mortgage as opposed to an insured mortgage. Now, for your first-time home buyers, when it comes to actually saving money for down payment, in video 1, I talked about if you had the ability to put money aside and to put it in an account that you can save. My next suggestion would be, I'd actually look at investing in that into an RSP. So what happens is when you have money in an RSP, you can use that for your down payment, up to $35,000. You have your RSP, up to $35,000, you can use that for your down payment. When you take it out, you actually take it out tax-free. It can be used for your down payment. You then have to pay it back over 15 years. So all they do is they take how much money you have, divide it by 15, and that's how much money you have to pay back a year. And either you have to put that back into your RSP or you have to add it onto your taxes at the end of the year as income. So besides the down payment, obviously rate, or the amount of interest that you're paying, is going to be kind of your next big decision you have to make. My suggestion I give to all my clients are talk to your bank, talk to your next favorite bank, and then talk to 1 or 2 mortgage brokers, which again, as a real estate agent, I have those contacts, so I can give that to you. And I would have at least 3, if not 4 quotes from those different parties about what you're going to pay. So let's go back to our first example we have. $400,000 mortgage, 3.2%, 25-year amortization was $1,940, rounded up, right? Now, if we take that exact same example, but we change the rate from 3.2 to 3%, you're actually going down to $1,896. Let's round up to 97 because it's almost 97. So $1,897. So that is, it's not a huge savings, but it's a significant savings when you're talking about over time. The other thing to think about too is the frequency of your payment. So the examples I've been giving you are just monthly, just because it's easier for our brains to just work with one number. But but there's monthly, there's bi-monthly, there's bi-weekly, and there's weekly. And there's pros and cons to each. Obviously, it's what works best for you. I'm a bi-weekly guy, just always have been. But that means sometimes I'm paying my mortgage 3 times a month because of just how it works out. But the amount of interest, your payment, all can be lowered just by changing that. So let's take our first example again. We have our $1,940 payment a month. Okay, that's just for the mortgage. In your first payment that you're making, that very first month you get your home, of that $1,940, you're paying $1,066 to interest, and then the rest of the money, the $872 some odd dollars, that's going towards your principal. Principal meaning the actual amount you borrowed, so the $400,000. So you're paying more money to interest than you are your actual principal. And that's how every loan works, but the process of paying more interest than principal, is a sliding scale. So the bank or lender gets their money back first, and then eventually it goes to where it flips, where you're paying more principal than interest. So just looking at my little program I have, my little cheat sheet for mortgages and stuff, it's actually not till month 41, which is 3.5 years, that you're actually paying more towards the principal than you are towards interest. Now, another thing to think about, a lot of lenders, not all of them, will let you put a chunk down on your mortgage once or twice a year. So what do I mean by that? So you have your $400,000, you're making your monthly payments, based on the monthly payments, you're going to be paid off that $400,000 in 25 years. If you have some money saved up, $1,000, $2,000, whatever, and you want to, as opposed to investing it somewhere else, you can put that money towards your mortgage. You put that $1,000 towards your mortgage, and that goes straight to your principal. There's no interest on that. That's just straight principal. So now your mortgage, whatever it was, is now down $1,000. And there's always a percentage. You can only put a certain percentage towards your mortgage so that the bank makes sure they get their money, right? Like if you put 50% down, then they're going to lose a lot of money on interest. So they only allow you to put a certain percentage down. All right, so let's talk about land transfer tax. I alluded to this in video number 1. As a first-time home buyer, you get to have up to $4,000 rebated back to you for land transfer tax. So there's actually a formula that you can take any house you want and figure out the land transfer tax right now. So for the money from $0 to $55,000, you get charged at 0.5%, which is a total of $275. The next bracket is money from $55,000 up to $250,000. That gets charged at 1%, which is a total of $1,950. Your third bracket is from money that is from the $250,000 mark to the $400,000 mark, and that gets charged at 1.5% for a total of $2,250. Anything over the $400,000 mark is charged at 2%, and that goes from $400,000 to the $2 million mark. Anything over $2 million and $2 million to infinity, that gets charged at 2.5%. So if we stick with our example of our $400,000 home, your land transfer tax is going to be a grand total of $4,475. So remember, you got a $4,000 rebate, so you're actually going to have to pay $475 in land transfer tax. If you're to go over the $400,000 mark, let's say you bought a $500,000 as your first home, you have to take that difference of from 4 to 5, and you have to now times that by 2%. So you can see how quickly numbers can add up. And that goes towards the goal of this video, is that you see how these little things can add up. All right, last thing I want to talk about in this video is property tax. Property tax is charged on every single property that is owned, whether that's a detached home, semi-detached, row house, high rise, it doesn't matter. Everybody who owns a property is getting taxed with property tax. So there are two options really. One, you save up that money and you pay it to the government at the end of the year, or two, you add it onto your mortgage payment. What I would suggest as a first-time home buyer is you add it onto your mortgage payment. What that's going to do is that's just going to put one thing out of your mind. You're not going to have to worry about it. So hopefully that helps. Hopefully it gives you some knowledge that you didn't have before. And again, obviously being a real estate agent, I'm going to boast and advocate for you getting a real estate agent on your side, because then that person can help you out with getting a lawyer and getting a mortgage broker or the right bank and getting the process and making it much easier for you. But again, hopefully this gave you some tips and gave you some knowledge you didn't have before. Stay tuned for video number 3, which can come out next week, which is all about your different costs, your different living costs and moving costs that are going to come into when you're buying your first home that you might not even think about. Until then, everyone, take care of yourselves, right?